Okay, great. Hi, everyone. Thank you so much for joining Revolution Mortgage today. We're so glad that you're here. So today we are going to, well, as part of Tony and Gabby's initiative to do more training in the month of May, we've scheduled the next, I guess, well, four, including this one Thursdays, to teach you guys different mortgage topics. So today we're going to be going over buy downs and leveraging those in today's market. As I mentioned earlier, next Thursday we'll be covering FHA loans. That's May 15th. May 22nd, we're going to go ahead and we're going to cover VA loans. And on May 29th, we're going to talk about non-QM loans. And obviously, beyond this, we're going to have more training, but this is sort of what we've decided to like focus on for May. So with that in mind, I'm going to go ahead and get going. Thank you again for being here. I'm going to start by saying I'm Leanette Fernandez. For those who I haven't met in person, I'm with Revolution Mortgage. We're your preferred lender, which means we're the ones that you call, hopefully. Every time you have a deal, we're actually inside the Extreme office. So I'm actually here right now. I'm right across from Gabby's. So you have easy access to us, and it helps to have everything sort of in-house between us and New World Title. So whatever you guys need, if you want to run a scenario by us, we're here. We have a Spanish speaking team as well. So we're here to accommodate whatever you need, and we're happy to help. So with that, I'm going to introduce Rob. I forget what his official title is. He just does it. Oh, he's just awesome. So I'm going to have him take over the presentation, and he's going to talk to us about buy downs.
All right. Thank you very much, Lynette. As she said, we are your preferred lender. We have offices all the way up and down Southeast Florida. We have offices in Palm Beach Gardens, Boca, Davie, Miami, Coral Springs. We are the largest branch for Revolution. We have our own processors, our own underwriter as well that we employ that only works on our loans. It is the best underwriter in the entire company. And so we do a lot of deals and we do the tough deals too. So if you're not giving Lynette and us a chance, please give us a chance. We think that we will surprise you and provide great service to your customers. And so that way you can always ask for referrals and reviews, which will help you get more business. So today we're going to talk about temporary buy downs and how you can use these to hopefully close more deals. Can you guys see my screen?
What? Yes.
Okay. So first of all, Revolution. How do I get next? Who is Revolution? We're a lender that offers low competitive rates and payments for refinancing and home purchase loans. We leverage technology to boost efficiencies in the loan process to give customers a low rate, fast closing, and a brand experience that's truly one of a kind. With brick and mortar office locations across the nation and a digital lending platform that produces a seamless online lending experience, home buyers are seeing firsthand the future of the mortgage industry. So to give you an example of the digital and the technology that we use, when we go to a closing, um, 90% of the loan documents are e-signed before the customer even gets there. And so when they get there, it's a very short, easy, fast closing. They'll sign, I think it's like 5 or 6 documents that they have to actually physically sign at the closing. This will give you plenty of time to take your photos, to post on social media, to celebrate the family that you helped and that's one of the ways that we leverage technology. Also, when we do a pre-approval for your customers, we pre-approve customers with a soft pull only to their credit. There's no cost, no obligation, and no impact to their credit because we do a soft pull. Once they go into contract, we do a hard pull, but just to find out what they're qualified for, there's no risk at all. So that's just a little bit about Revolution and who we are.
Question.
Sure.
What is the difference between the soft and the hard inquiry in the credit?
Yeah, so a soft inquiry has no effect. It does not show as an inquiry on their credit report. So one of the things that I hear a lot from people when getting pre-approved, are you going to pull my credit? Are you going to hit my credit? And the answer is no, we will do a soft pull only up front. And so that's something that a lot of people don't do. There will be a hard pull, but a hard pull will show as an inquiry and that will affect their credit score. But a soft pull, there is no credit impact.
And what includes in a soft pull?
They go online, complete a pre-approval request, enter in their information, and then I'll pull a soft pull I'll pull all three bureaus on a soft pull. Does that help? Does that answer your question?
Yes, thank you.
Okay. And so the purpose of this is to help guide more buyers into homes by understanding how temporary buy downs work. So when we talk about buy downs, there's two different types of buy downs. There's a temporary buy down and a permanent buy down. I think that right now, customers get a lot more bang for their buck and benefit by using a temporary buy down as opposed to a permanent buy down. And the key benefit is to lower their initial monthly payments, which equals greater affordability and more deals closed. Because as you'll see, these buy downs, there's different types of temporary buy downs, and you'll see that they can get substantial savings. I mean, it can be all the way from like 3% on the first year to 1% on the first year. So if, their typical note rate is like 6.75% or 6.5%, if you do a 3-2-1 buy down, the note rate would be 3.5% on the first year, and then 4.5, and then 5.5 the second and third. So there's a lot more substantial savings on the temporary buy down. So what is a temporary buy down? A temporary buy down is a dollar for dollar buy down paid for by the seller or lender or real estate agents or combination of the three that reduces the interest rate. The temporary buy down can be anywhere from 1 to 3 years. The longer it is, the more it will cost. It can also be funded by a builder as well. And it helps buyers ease into payments as income or comfort with the home grows. So if you have a professional that's going to be getting raises every year, or it's a commission-based employee where they're growing their business, this can be a great benefit to them because it'll create more affordability, and they know that their income could increase. Or if you believe that interest rates will go lower, then it helps make the payments affordable during a higher interest rate environment, so that way they can refinance into a loan at a lower rate at a future time. We believe interest rates will decrease. We do not know it for a fact, but at some point in the next 3 years, we would expect to see lower interest rates. But nobody has the crystal ball. Nobody knows for certain. But I can tell you that if a recession is on the way, typically during recessions, interest rates will decrease and housing prices increase due to that. And so recessions are really good for housing. If you look at historical data, I don't know if one is on the horizon, but a lot of people do predict it. But nonetheless, those are good scenarios for people, if it helps create affordability for them. So what are buy down structures, or how are they structured? Like I said, it can be anywhere from 3 years to 1 year. And there's different variations of the buy down. Really, what it boils down to is how much can the seller pay, or how much are concessions are they getting, or can they get, really? Because the longer and the more you get, the more it will cost. And so a couple of the buy down structures that we use are 3-2-1 buy downs. This is where the rate is reduced by 3% the first year, 2% the second year, and 1% on the third year. And so how it works is the customer will have a note rate. Let's call it 6.75% today. That's about what rates are going at. And they close on a 3-2-1 buy down. That means the first year it would be 3.75. They would pay an interest rate of 3.75 the first year, 4.75 the second year, 5.75 the third year, and then the remainder of the period goes back to the note rate. And they always have to qualify off the note rate. So this will not help them qualify for more. They still got to qualify for the payment based on the note rate, but it helps the payments. You have a 2-1 buy down. So you're looking at 2% for the first year. So on that one, it's 4.75. And then the second year, 5.75. That's 1 point off. And then the rest of the term would be 6.75. 1.0 buy down is 1% off the first year. Here is an example of a 2-1 buy down and the math on how it works. So for this scenario, I used a $400,000 loan, 6.5% rate as a note rate. And so the principal and interest at 6.5% is $25.14 a month. Year one, the payment's $20.26. That's $488 a month they save for year one. Year two, they save $243. And then year three, that's the normal note rate.
So Bob, it actually affects both the mortgage and the P&I.
For sure. Yeah, the P&I is what it affects. Now, the cost of this is a dollar for dollar cost. So the first year, they're saving $502 a month. 502 times 12 is 6,024. Year two, they're saving $257 a month. That's $3,084. So the cost of that is $9,084. So you would get sales concessions in the amount of $9,000 to cover this. And if you could only get five, or let's say you can only get 7,000 from the seller, agents can contribute to this. Lenders can help contribute to this as well, which we can help with a little bit as if you need it. But it's a dollar for dollar cost. And so this money is held into an escrow account by the loan servicer, and this money gets applied to the payment every single month on their behalf. So it's held in an escrow account and it's applied to the principal every single payment by the mortgage servicer. Nothing you have to worry about or do. It's all done through the closing. But that's how it works, the math. And so like, let's say you could only get, that same math on a 1.0 buy down, they would say, let's say you couldn't get all that for concessions, right? Every single scenario is going to be different depending on the seller and the property. But like, let's say we're just going to do a 1.0 buy down. That would save them $257 a month. So the cost of that is only $3,084. So you could do a 1.0 buy down with only $3,100 in concessions. You can also do a 1.1 buy down. So let's say they wanted a 1% off for 2 years. The cost of that would be $3,084 times 2, so $6,168. So it all depends how much concessions we can get. And so this again is the slide for who pays for the buy downs. You have sellers offering incentives. This is the same as seller concessions. And so seller concessions can be applied to this, or they can be applied to closing costs, prepaids, combination. And it can be paid by lenders, realtors, and builders. Like I said, the buyer benefits are lower initial monthly payments. It creates more affordability, easier transition into home ownership. So sometimes first time home buyers are shocked by the payment. They don't like the payment. Well, it's because interest rates are a little bit higher. This could help ease into the transition of home ownership. And it's a great option in higher rate environments like now. You can also use this on listing agents or listings. If you're a listing agent and you have a listing, as opposed to a price drop, talk to them about offering concessions to go towards a temporary buy down. It'll make more homes appealing to more buyers. It also helps maintain home values. So, if you have a house that you sell for 500,000 and you drop the price $50,000, now that comps at 450. But if you sell it at 500 with a $15,000 closing cost credit to be used towards a temporary buy down, the value in the comp would still be 500,000. So it also helps maintain home values in neighborhoods. And it often costs less than a full price reduction. So to give you an example, if you have a house at 500,000, this customer is going to put down 10%. So they're going to finance 450,000, okay? And you're weighing the option of either dropping it 25,000 or giving seller credits of 15,000. Each individual scenario will be different, but I'm going to use this as an illustration to show you the bang for the buck the buyer will get and how to use it to attract more buyers, right? So at 500, customer is going to put down 10%, so they're going to finance 450. Principal and interest payment is 2828. And let's say they get an interest rate at 4.5%. So they're going to do a 2-1 buy down. That brings the principal interest payment to $22.71. $556 a month they save. Now, let's say it's an alternative to like a $50,000 price cut, right? So now the purchase price is 450. That customer is going to finance 90%, so 405 at 6.5%. Their payment's 2546. 2546. In order to get that monthly payment, the customer would have to finance at 4.5%. I'm sorry, it's 6.5%. This is a tough calculation. 357,000. So that means that the buyer is getting a payment that feels like a $150,000 price drop. And it only costs $6,500 for the first year $3,100 for the second year. So it costs your seller less than $10,000. And it feels like on the buy side, they're getting a payment difference of 150 price drop. I don't know if you follow that math.
No, can you show that math on the screen? Do you have something like that that can, no?
No, I don't.
Okay.
So the payment at 6.5%. If the purchase price is 450, right, and they're putting down 10%, they're going to finance 405. The payment at 6.5% is 2546. Right. So if you take 2546, make that a payment, and then you take the rate that they'll get at 4.5 and work that backwards to get that payment of 2546. I'm sorry, to get the loan amount, hold on. You use the 2280. So 2280, which is the payment with the 2% discount. So if they take that 2280 principal and interest, that's the rate at 4.5% at a normal purchase price, right? So at 500,000, if they're putting down 10% and financing 450, their payment's 2280 with the 2-1 buy down. That's the interest rate discount. So if you take 2280, work that backwards with a rate at 6.5, 362,000 is what they would finance. That's if they had a note rate at 6.5%, their payment was 2280. Their loan amount would have to be 362,000. I'll break it out better for you guys because I know that's not easily clear. But you can use, so my point is like, this is not just for buyers. This is for listings as well. And it's a great alternative to a price drop.
Rob, I have a question.
Sure.
What
Fire
would be
away.
the benefit considering if the seller's offering 15,000 for buy down, why wouldn't you just do a permanent buy down your rate and keep
Yeah,
it for
so
the
great
30-year
question.
loan?
Great question. So you're going to get a lot more bang for your buck. So if they're offering 15,000, which is like on a $500,000 loan, that's a 3-point buy down. Your note rate instead of 6.5 would probably be like 6.125, maybe 6%. And so you're not going to save as much money monthly. Also, whenever you pay on a permanent buy down, like let's say you do a permanent buy down with the 15,000, you get a rate at 6%, but then interest rates go down and you refinance in the next year to 2 years, right? That money is gone and it's lost. So on a temporary buy down, any unused premium gets returned to the customer in the form of a principal reduction. So let's say interest rates go down in a year and they refinance. And so they only used the 2% of the buy down, right? So they had that whole 1 year left. They get that money back in the form of a principal reduction. It's not forfeited where it would be on a permanent buy down.
Okay. I
Does
mean,
that make
but
sense?
that would only benefit if the interest rates drop that much for them to want to refinance.
Yeah.
Okay.
The
All right,
savings
thanks.
from 6.5, just so you know, the savings on payment from 6.5 on a $450,000 loan 2684, 2684. $145 a month.
For the life of their loan.
That's correct. So it'd really be a buyer preference. I mean, we can do either one. So you can say, well, spend
realistic.
15,000. Well, it's probably like 450 times 3 points. That's 13.5. So you can spend 13.5 to save $145 a month, which takes 93 months to recoup. 7.75 years. So they'd have to be in the loan longer than 7.75 years to make money on that example. Whereas a temporary buy down on 2-1 costs 3 points the same cost. That first year, they're going to save $558 a month for the first year. And then the second year, they save $278 a month. And oh, by the way, if rates go down in the next 2 years and you refinance, anything that you don't use gets returned to you. Whereas on a permanent buy down, that money's gone. You don't get it back. And each person will have their own, their own opinion about it. It's whatever their customer prefers. But I think you get more bang for your buck on a temporary buy down.
A question, Rob.
Sure, go ahead.
So when the seller offered this concession to the buyer, that money is not actually not coming out of pocket from the seller. It's actually reducing from what the seller is getting.
Yeah, that's right. That's correct. It comes out of their proceeds.
Okay.
Just like a normal concession would, like if you just offered 13,000 for sellers paid, closing costs, prepaids, etc.
So you're saying that it's basically better offer this concession to buy out the rate instead of giving a big discount on the price
Yeah, correct.
for seller. Okay, all right, it makes
And
sense.
I'm happy to, if you have any specific scenarios, I'm happy to run the math for you and just give you a breakdown on the actual specific scenario. So then you can go and talk to your sellers about it in more detail and have exact numbers. So you can say, hey, if we offer this temporary buy down, and you can actually advertise it. I've had it advertised in MLS before. Seller offering 13,500 towards temporary buy down. Please contact Leanette at Revolution Mortgage for inquiry.
Okay, but that will be, I think that will be a conversation that I can have with the seller if we receive an offer over the price, and
Yeah.
then we can say, well, wait a second, let's not reduce the price. However, let's give this option, which is better for the buyer, and explain it to your buyer, I guess.
Yep, correct.
Okay.
And so this is just kind of the same thing. Ideal scenarios for buy downs, buyers with expected income growth, higher rate environments, first-time home buyers needing payment relief, sellers needing extra leverage to get homes sold. So some of the key considerations about this product is it's only available on certain loan types. Not every single transaction can get this. It can only be used on primary home purchases and second home purchases. It can be offered on multifamily up to 4 units, single family, condos, townhomes, jumbo loans. But we're limited on investors on who we can go through with jumbo loans. So different jumbo loans will have their own guidelines per the bank. Most jumbo loan providers offer it, but not every one of them. We can do it on some non-QM loans as well. So like bank statement loans, we can offer them for non-QM. We can't do DSCR loans for them. We can't do foreign national loans on these. But FHA, VA, USDA, those all will use it and allow it. And it cannot be paid by the buyer. None of it can be paid by the buyer. So if there's any shortage at all, the concession would have to be either made by the lender and or the realtors to cover the difference. And so none of it can be paid by the buyer.
Excuse me, sorry. I thought for some reason I thought that at the beginning of the presentation, anybody could buy this, the realtors, developer, seller, but I thought it was also the buyer.
No, it cannot be everybody but the buyer.
Okay.
Sorry if I said that, but the buyer cannot pay
Well,
for
maybe I understood wrong incorrectly.
it. Glad we got it cleared up.
Mhm.
And like I said, the funds escrowed at closing, the actual loan servicer will be the one that applies it to the principal every single month. They'll see it on their statement every month for the money.
Sorry, I don't know if you said this, but what is the cost to buy it? Is it for each point, it's how much?
It's a dollar for dollar cost.
Oh, that's right, dollar for dollar. Okay.
And so if they're saving 200 a month, that's 2,400 for the first year. If you do like a 1-1 and it's 2 years, then it's 4,800. And every scenario will be different. And so that's just important. This is why it's important to have clear communication so that we let you know exactly how much you need to ask for. And it'll have to be worded in the addendum that it goes specifically to a temporary buy down.
I guess the
Right.
key here would also be for the other realtor needs to understand how this works because they're gonna have to sell it to the
That's right.
seller.
And I call listing agents all the time. Whenever somebody makes an offer, I always call, introduce myself, let them know I personally verified their income and assets. These customers are able to execute. And if they accept our offer, then I'll call that listing agent every single Tuesday, give them an update, let them know where we are in the process. That way they can deliver a great experience to their sellers, and we can all go back at the end of closing and ask for reviews and referrals. That's what I say every single time to all the listing agents. So they like it. It helps. And I can help explain this. And we can show different, like there's calculators that we have as well, where I put in a scenario and then it'll spit out the results for us so we can email it, make it clear. And so the big thing is the way that these work is we all have to work together. We're here to help you structure the deals for you, your customers. We're here to explain it to listing agents as well. We just need you to know enough to be dangerous. You don't need to be experts on it. But it does help create a lot more affordability in today's market. And so, we think that you can use it to maybe get one more deal a year. But if you don't know, you can't talk about it, and that's what we're here to do. So it all stems to work together and work as a team, and that's what we're here to do is help you guys. Here is all of our contact information. You guys just reach out to Leanette whenever you need anything. She's very responsive. She's available all the time, cell, email, whatever is easiest for you guys.
Sounds good, thank you.
And so we'll keep it brief today just because it was a temporary buy downs and there's not too much to cover. But, what questions do you guys have?
I'm good.
Last question. So, is this buyout program is taken by all of the mortgage outside out there, or few, or everybody is taking this option, accepting this option?
Yeah, I mean, some do, some don't. It's hard to say which ones do and which ones don't. I just know that we do.
Okay.
But I would think most people would be familiar with this. It's a pretty hot topic in the mortgage industry.
I'll follow up too with some flyers that we have that have examples of the buy downs as well. So I'll send that out to you. And then if you have any specific questions, feel free to reach out and we're happy to address those as well. I know it's a lot to process. So maybe as you're processing it and looking over the flyers, if you have any specific questions, just reach out.
Yeah, I mean, it's just another tool in your toolbox for everybody. So it's not going to work with every single customer, but it will help with somebody.
Any other questions about this? Or if you want to write in the chat too, anything that you'd like to see in the future that you want us to break down. Like I said, we have coming up FHA, VA loans, and then non-QM. We'll be breaking those down, sort of like what's involved, and then you can think of some questions for that as well. But if there's any other topics you'd like us to cover, we're happy to do that.
Yeah, assumption of mortgage. I know that, I mean, it might not have anything to do with you guys doing the loan, but maybe the theory or the concept, how it works for assumption of mortgage.
Yes, that would be great too. Yeah.
I'll leave that to you, Leanette.
Okay, but as a separate, wait, as a separate, well, that's not something we're gonna do now. Where I was saying, like, for future ideas, I'm writing down a list of names, a list of ideas of the topics that we can cover.
Here's
So
what I'll tell you about assumptions of mortgages. Very few mortgages are assumable. Really, the only ones that are VA loans. And if somebody assumes a VA loan, that does not clear that veteran's entitlement. So let's say that veteran wants to go buy another house
You
and
won't be
somebody
able to.
assumed their loan, they will not probably be able to buy a new home without any money down. They'll have to put money down because that other entitlement is being used up. From my experience also, from working at one of the largest banks in America for 15 years, assumptions do not get approved easily. They're a very difficult process and most don't get assumed. They don't qualify. And so my personal opinion is a lot of it's not great, right? It's kind of a waste of time.
okay, well, I guess we don't need a class for that then. That was covered.
So that's
Covered.
my take on them. I mean, it's the reality is if they want to buy the house, they need to qualify and go buy the house. But I don't know. Maybe I mean, every scenario is different, but number one, if it's not a VA loan, chances are it's not even assumable.
Okay,
9 times out of 10.
thank
Leanette,
you.
Yes.
what about a course class talking about grants given by cities or states? I have a lot of well, a few buyers asking me for that, and I have
Yeah,
no clue how to
we're
apply or how
registered
they
with the
apply.
state for grant programs. We're registered to do the Miami HFA program. We're approved to do that as well. And so we offer those. We're approved to do them. We can present on that.
Okay, I made a note of it. Thank you.
What is when somebody tells me, oh, how much am I gonna pay in closing costs? What's that, just like a good
$15,000.
for any loan? Any
I
size
just like
loan? Or do I calculate it as, oh, 6%, 5%, 4%?
Are you saying like where you can give like a range of maybe like 3 to 4% or something like
Yeah.
that? Rob, what is it in your experience? You're saying 15,000, but
I'm saying 15,000. That includes first year homeowners insurance premium, everything. And that's anywhere from 300 to 500.
Okay.
If you want to go more, use 3%.
Okay.
But roughly it's usually about 15 to 20.
Okay.
There's a title company that I use that has calculators that you can just enter the info in and it'll give
I'm
you a
sure
total.
I'm sure New World Title has
Yeah, they
calculators
Yeah,
make
it's just
available.
when I'm having a conversation with somebody.
Oh,
usually
yeah.
it's 15 grand for me. 15, and then if it's like a higher end property, 20.
Okay.
That's for buyers, not
Mhm.
sellers.
Mm-mm.
That's what I'm talking about, buyers, not sellers, just to be clear.
Anyone else? Questions, topic suggestions before we wrap this up? If not, you guys know how to contact me. So I'm always happy to help. Just let me know.
Thank you.
And with that, thank you guys so much. We appreciate you guys being here. Hopefully you guys will join us again next week where we cover FHA loans. So have a
Thank
great
you.
week. Thank you
All right.
guys so much.
Bye.
Thank you.
Thanks, guys.
Bye.
Have a good
Bye.
day.
The recording, Leanette. Leanette, stop the recording.